All right. Welcome. So before I forget, all of you in Payson and Globe, if you can, if one of you in each room or wherever you are can email pam.woods@eac.edu who is in attendance, she would greatly appreciate that. So I don't know, look like there's a couple rooms that you guys are using. So if you can email pam.woods, that'd be much appreciated. For those of you that don't know me, I'm Wayne Layton. I'm the controller, director of fiscal control, leadership guy, I guess, for this round. So I try to get out of this because accountants don't like to be in front of people very often. We like the back corner and whatever. And Pam assured me, you know, on average, there's 10, 12, maybe 15 people that show up. 40 people later, here we are. I don't think it has anything to do with popularity. I think I just got tricked into it. So anyway, let's get moving. So I had to put a picture or something up, like, where do we want to go? We want to get on the beach, on the golf course, whatever. Got to get to retirement. So today I'm hoping to talk about how to plan for retirement, what options you have as an employee of EAC to help execute that plan, and the pros and cons, advantages, disadvantages of each of the options you have. And then, of course, ask questions. During, after, whatever, the more questions, the better. I don't want you to fall asleep either. So ask questions along the way, and I'll do my best to answer them. And I'll also throw this out, that this is not a sales pitch to try to get you to do one thing or another. Everyone's situation is different. So this is information, and then you guys can decide what to do with it. So my guess is a lot of you are probably one of these people, and it's understandable. Retirement is something a lot of times you think, oh, that's so far in the future, or you start thinking about it and it gets kind of overwhelming, and so you stick your head in the sand. And so some of the mistakes and concerns that happen with planning for retirement are you don't know how much to save, or you don't know how much you're going to need. You're worried you're not saving enough. You're not using the tools and the options that are provided. And as you start thinking about those things, that's what results in being overwhelmed. So it says at the bottom there, you can create a plan.
Is there staff signed up?
So one of you at Payson or Globe are not muted anymore. How do I do this? This one?
Yeah. There you go. Don't touch it. No, you're fine. No, the box.
Well, I'm waiting to see what happens here. This one or this one?
No, the box. Then they can, yeah.
Hold on, I want to see. So those of you in 535, can you still hear me?
Yes, we can hear you.
All right, I'm gonna mute you because we could hear you.
Okay.
So if you have a question, then you'll have to unmute and ask, but otherwise you'll be muted.
Okay.
All right. Did I do something wrong? All right, so you can't create a plan to meet your retirement goals if you don't even know what those goals are. So, things to think about to make your retirement or to plan for your retirement. At what age do you want, and yes, want to retire? Today? All right, we'll get to that. What will your monthly or annual expenses be in retirement? Some people like calculating monthly, some people like doing annually, some people like doing monthly and then convert it to annually, whatever. How many years will you live in retirement? I mean, obviously that's a guess, but based on genetics, how long did your parents or grandparents die? Or how long do they die? How long do they live after retirement and stuff? So, and then how much money will you need? So based on those number of years and how much you think your expenses are going to be. So you got to figure out some of these things. Then after you do some of that, then it'll tell you if you can retire. So you might want to retire tomorrow, but can you? Did you make a plan so that tomorrow you can retire? So think about these questions and think about when you want to retire and see if you can make a plan that will allow you to do that. If you want to retire at 62 and you're 55 right now, that may be a little tough. But you think about these questions and then see if you can create a plan to tuck away enough money to be able to retire at that age, considering maybe you might live for 30 years after that or whatever it is. So one thing I wanted to illustrate is some people, as they're doing retirement planning, they say, you know, what I make right now covers my bills. I could live comfortably in retirement. So I just need $5,000 a month because in retirement, or right now I make, my contract's $5,000 a month. So in retirement, if I have $5,000 a month, I'll be good. But I'm here to tell you that $5,000 actually equals $4,000. So while you're working, if your contract is $5,000 a month, of course we take out Social Security tax, we take out Medicare tax, we're taking out Arizona State retirement. So you get a check of $4,000. Of course, there's a lot of other deductions we have, but to simplify things, I didn't take into consideration health insurance and all the other things we take out. So you're getting a check for $4,000. When you retire, wherever your retirement money is coming from, Social Security, ASRS, some retirement plans that we'll talk about in a second, you're not going to have Social Security tax. You're not going to have Medicare tax. You're not going to have ASRS being taken out of your check. So if you're thinking, I just need what I have today, you can actually have less and still cover what you covered today as far as expenses go. Does that make sense? All right. So next time you see Ray Orr, tell him $5,000 equals $4,000. If he doesn't believe you, he can come talk to me. So options. Social Security benefits, can't really do anything about that. We take 6.2% out of your paycheck. It goes to the government. They wisely invest it for you to have this huge nest egg of money for you at the end, or not. The Arizona State Retirement System, all full-time employees are enrolled in that, whether you like it or not, that happens. So right now, the rate, no, I'll get into that in a second for Arizona State Retirement. The college has a section 403B plan and a 457B plan. I want to see how many of you have ever heard of those before. Wow, that's good. So a lot of you have heard about those. How many of you know what they are? That's good. So if you're bored one day, the section, these numbers refer to the Internal Revenue Code. It's really good reading. There's even more regulations on top of it, so you can read those, learn all about it. It's good stuff. You become a nerd like I am. So the college has 403B plan, 457 plan, and then of course there's also individual retirement accounts, IRAs, that you could do on your own for your retirement planning. So let's talk about each of those. I'm not going to talk about Social Security benefits because it is what it is and can't really do anything about it. Arizona State Retirement System, that also is kind of, it is what it is, and you can't do much about it, but as state employees, I wanted to help you understand a little bit more about what that is. So this year, this fiscal year, we withhold, the college withholds 12.11% out of your paycheck, and it goes to the Arizona State Retirement System. And I say this year because they do these crazy calculations every year and adjust the percentage. I've never seen it go down. It always goes up. Last year, I think it was 11.8. So we went from 11.8 to 12.11. And each year they look at it to adjust. So right now, 12% is coming out of your paycheck, and we send it to the state retirement system, each payroll, on your behalf. How many of you knew that the college matched and also contributed the same amount? Did you know that? So 24% of your contract, well, it's not really of your contract, of your gross wages, gross taxable wages, goes to the state retirement system. So that's a pretty good start to a retirement plan. Some people have asked me, so how do I plan and how do I know what I'm going to get when I retire? Like, if I know my expenses are X. Luke, you have a question?
This might be a different question.
There's no such thing.
When you say that 12% by EAC, does that go to the state, or does that go to our individual, or is there an individual one that is contributed?
That's a great question. So that goes to the state on your specific behalf. So the state, I tell the state of Arizona, the Arizona State Retirement System, here's 12% out of Luke Hatch's paycheck. Here's another 12% for Luke Hatch that the college is contributing. So you won't really ever feel or receive that money directly until you retire, and they calculate how much you're going to receive. Does that answer your question? Yeah. So it won't show up on your pay stubs. It's not part of your paycheck. It all happens magically. Kay makes it all happen magically behind the scenes. Yeah. Any other questions so far?
Yes, I have a question.
Let's hear it.
When you go to the ARS website and you look at your income and your wages and stuff that are in your account now, does that number reflect that 12.11% that EA has donated to?
That is a really good question. I've never even looked at it. Have you looked at it, Kay?
The vested amount, I think, is only what you have contributed until you retire.
That's what I would.
That's
what I would guess is that is your portion. But I can verify that. Who is asking that question?
This is Daryl Meeks in Globe.
My guess is that's only what's coming out of your paycheck. Yeah, okay. It doesn't show the colleges.
Okay, thank you.
It's just your part. And that's most likely because if you're not eligible for retirement and you leave, they don't want to mislead you and make you think you have a lot more than you really do.
Understand. Thank you.
Any others? Yes.
That kind of equals my question. Of course, everybody's going to stay here until retirement and everything is perfect. But if you leave, you don't get the contributions that EAC has made on your behalf. If you take a lump
if you leave the ASRS system,
Yeah.
yeah, then you're not gonna,
You
you haven't vested in that.
Contributions, but not college.
Right. If you leave before you're eligible for retirement, then yeah, you're not gonna get that. Now, if you leave and you go work for another ASRS employer, a K-12 or whatever, then all that goes with your account.
And you said that after 10 years, you're invested, you get 100% of what you get put into your account as well. Does that affect it when you're here 10 years and then?
So I think it's different for, they changed some of the rules after June 2011. So if you entered the ASRS system before June 30th, 2011, I didn't look up the vesting schedules, but your vesting schedule is shorter. I think it's 20 for anyone that entered the ASRS system after June 2011. So it may be 10 before 2011, but after 2011, it's going to be longer. I think it's 20.
Does that, do gaps affect that? So for example, if you
If you're,
entered ASRS in 2009, then had various gaps in which you're not paying into ASRS or whatever with employment, it just resumes and you're still grandfathered in because you're originally.
so if you started working for Thatcher School District in 2009 and then went and worked for Freeport, is that what you're saying? And left the ASRS system and then now you work for EAC and you're back in it?
Yes.
Then yeah. Yeah, because you enrolled in ASRS in 2009. So you're part of the system in 2009.
As far as like collecting Social Security, if you were in the system by 2009, can you start collecting it at 65? Some people said it's up to 67, stuff like that now.
So Social Security follows a whole different group of rules. So 65 is when you're eligible for Medicare. It's based on your birth year of when you can, when your Social Security kicks in. So you can actually start taking Social Security benefits as early as 62. It's going to be discounted because you're taking it early. But you can take Social Security benefits as early as 62. But your full retirement age, if your birth year is after 1954, then your full retirement age is going to start creeping up. I think if it's 1957, your full retirement age is 66 and 6 months. And then it bumps up until 1955 or something. It's going to go up to 67 years old. And that's when you would get your full Social Security. But that's a whole different set of rules from the ASRS system.
Okay, one last question. I won't ask anymore. Like if I'm covering the family on insurance, the flex money that's given to us at college, then to get myself up to the highest 3 years before retirement, that money's not included until if I'm just covering myself and the family goes elsewhere, right? And then that would bump it up to the higher income towards retirement.
Are you asking if the flex is included in that?
Right.
It is, but the health insurance comes out before. So
if I quit covering the health insurance for the family,
then that would
check
increase
myself,
it.
That would increase it.
Yeah.
Like say my last
A
2
little
years
bit.
before I decide to retire. Okay.
Yeah. So on that note, right here on the formula of monthly retirement benefits, it says average monthly compensation is one of the variables. And I have 36 or 60 months because of that June 30th, 2011 difference. If you enrolled before 2011, it's the highest 36 months. If it's after 2011, it's the 60 months. So it depends on when you enrolled. It'll be either 36 months or 60 months in this calculation. And as far as if you were going to try to estimate the graded multiplier, that's going to be 2.15 to 2.3%, depending on how many years of service and stuff. It's all on the ASRS website, but it's right up there at 2.15 to 2.3%. Great questions. Any others?
I have a question, just to put it out there, the ASRS website has a great little tool that you can go and put in these different formula amounts, and it can estimate for you what you would be getting.
A calculator type retirement calculator. That's good to know. So you put in probably like the year you enrolled or started in the system and stuff like that. Wage. Okay. All right, that'd be very helpful. So ASRS website. I'm going to repeat that for, I don't know if Payson and Globe heard that, but the Arizona State Retirement website has a payment calculator that you can punch in variables of when you want to retire, when you entered the ASRS system, and it'll help calculate your retirement benefits. So, all right. Also, just so you know, all those benefits, most of those benefits will be taxable. So you retire, you start receiving the paycheck from the ASRS system, and they'll send you a 1099 showing here's your total distributions and here's how much is taxable. So plan on paying tax on that. All right. So the other options the EAC offers is the 403B and the 457 plan. These are basically the same thing. A lot of people have heard of 401ks. They're very similar, basically the same thing as a 401k, but for government nonprofit entities. So the advantage of these is you can save more. It's a tool to put more money into your retirement accounts. You can lower your tax bill because it's coming out pre-tax out of your paycheck. You still do, you're still charged Social Security Medicare tax on that, by the way. So just because people say it's pre-tax or whatever, that's just income tax, not Social Security Medicare tax. And then the interest, dividends, capital gains that those accounts earn while you're still working, well, even after you're done working, those are not taxed until you take the distribution. So it can grow, and hopefully it only grows, not goes down, but that happens sometimes. So it grows with no tax. The disadvantage is that's money out of your paycheck. So less cash flow to use right now. There's a 10% penalty if you pull it out early. For the most part, early means 59.5. If it's before you're 59.5, you're going to get penalized most likely. There are some exceptions to that. There's a whole list of these random things that usually don't apply to people in the IRS code. One advantage from that a 457 plan has is if you're retired and it's before and you're younger than 59.5, you actually can avoid the penalty. There's actually some ways to do the same thing with the 403B, but it's a lot more technical and a little more difficult. And if you're in that situation, you need to seek some advice from a CPA or tax accountant, financial advisor, and get some advice very specific to your situation. But that 10% penalty will hurt because it's going to be that plus tax. And I've seen people lose almost half of it when they pull it out early.
So, Wayne, so if I say I had money in a Edward Jones account and I wanted to take that money out and just put it in one of ours, you can't do that?
So these 403Bs and 457 plans have to be what's called a salary deferral, has to come out of your paycheck. So you can put your entire paycheck in there and then use your Edward Jones money to live on.
But then would I be taxed on it again? Like I would be?
The Edward Jones money?
Yeah.
Well, it depends on what that's coming out of. So it depends on what kind of account you have at Edward Jones. Is it an IRA? Is it an old 401k? Is it
IRA, I believe.
is it a Roth IRA? Is it traditional? I mean, there's so many variables. So that's where you need to sit down with someone, a tax accountant or Edward Jones, and figure out, okay, what kind of account that is that, and what's going to happen if I pull that money out. But I've seen people do that where they put nearly their entire paycheck into one of these and live on other money to boost these up or to save taxes or different situations.
Contributions are limited.
Yeah.
You can only put so much in.
Yes, sir. So I'll get to that. Next slide. Great point, though. So the only other disadvantages, so capital gains, actually there's a preferable tax rate. The tax rate's a little bit lower than other income. But when capital gains are earned in these accounts, there's no preferential tax treatment when you pull it out. It's taxed at ordinary income tax rates. So you kind of lose that advantage if you're investing through one of these. So a couple other just random things related to 403Bs and 457s. I always throw in there that if you don't have an emergency fund, a savings account that's liquid you can get to right now, my opinion is that should be your priority, not a retirement account. I've seen it all too often. People get so excited about planning for retirement and they throw tons of money into one of these accounts, and then they end up with a broken car or a medical situation and they need the money. And so they go and pay the 10% penalty, they then pay all the taxes, and they pull out $10,000 so they can pay a $6,000 bill. So make sure you have enough money outside of the retirement account to cover any emergencies and things like that.
You take loans against these accounts like you can a 401?
No.
Yeah,
That-
that's not true. Mine, you can take a loan, but your original amount stays the same, but you pay interest on that loan to pay it back.
So our plan, I didn't think our plan allowed it, but maybe it does.
Maybe this is a different plan.
Which,
EAC's plan.
oh, it's not. So there are some plans, these plans can allow loans against them, but I don't think EAC's plans allow loans against them. Danny, were you saying you took a loan against an EAC
No,
plan?
I'm just saying on my particular 403B, you can take a loan against it. It takes money out of your account, but it keeps that original amount, so that original amount's still earning interest.
Yeah, because you're gonna have to pay it back.
That loan with interest as well.
Yeah. So it is a possibility. I thought our plan did, but maybe it does.
I don't know about, you say your plan, EAC, is it an EAC 403B or?
Yeah, it's an EAC 403B.
Like mine's the ING.
Yeah, my 403B is through somebody else.
Well, sorry, it's probably misleading. So when I say EAC 403B, it's a plan, but EAC just offers the plan, but you're invested with TIA, CREF, or Modern Woodman, or
You just manage the contribution.
yeah. So EAC, it's a plan that EAC has, and we dictate the specifics. Which, if that's what you're talking about, then we do allow loans. I didn't look that up. But here, let's see, fourth bullet point. Here's some of the companies that are authorized. They have to be board authorized companies. We have options of American Funds, Modern Woodman, North American, TIA, CREF, Vanguard, Nationwide. There may be a couple others, but so when I say EAC plan, we don't.
No, you don't hold the money.
We just take the money out of your check and give it to one of these guys. So thank you for clarifying that. So second bullet point here, there are maximums that you can contribute. If you're under 50 years old, the most you can contribute to these plans is $19,000 per year. Now, you can contribute $19,000 to both of these at the same time. So a lot of times it's hard for people to hit the max. I mean, because that's $38,000 in a year that you can put into one of these accounts. So you could do 12% into ASRS and then $38,000 more. So it's rare for people to hit the maxes, but it is limited. If you're over 50, the IRS must feel bad for you and think you're starting late, and so they let you put in an extra $6,000. Your max is $25,000 for a 403B and also $25,000 for a 457. So you could do up to $50,000 a year, each year into these accounts. And I'll get into some examples to show some things I like to do with these, or I've helped people do. Now, once you decide, if you decide I want to put $250 a paycheck into one of these accounts or both, and a couple months go by and you're like, that's way too high, it's getting too tight, come see me and we can adjust it. It's not like you decide and you're locked in forever or a certain term or whatever. We can adjust those. So don't feel like you have to hit the perfect number right now. It may be better to start low and ease up, and depending on situations. I mean, I've had people come in and they lower it because of a situation, they need more cash flow, and so they lower it a little bit. So you're not locked in to whatever you elect for the college to take out of your paycheck. We talked about the companies that are authorized. I'm not going to get into which ones are better. I don't really have an opinion on that. You're going to have to, I'm not going to give you advice on that. You'll have to figure that out. One thing I will say is within the last year, we worked with Nationwide. They have a 457 plan that is joint with ASRS, and the fees are to administer that plan are way cheaper than if you just went with the Nationwide plan. So that's something we changed within this last year to provide that option, because we had people in a Nationwide plan. I can't remember what the fees are, but they were in the Nationwide plan, and we created this other option of the same Nationwide plan, but administered through ASRS for a 457 plan, and their fees are way lower. So if you happen to be in a 457 plan right now and it's with Nationwide, you may want to check to see if it's the one with lower fees.
So if you have one with a different company, and can you roll over what you have?
Absolutely.
Okay.
You can move, if you're with Modern Woodman and you want to move to TIA CREF, you can make that happen. There's paperwork and there's particulars. Don't just call them up and say, hey, send me a check. You can do it that way, but then the clock starts ticking. You have 60 days to move it, and it gets kind of sticky, and you're taking some risks. They can do it from one company to another company directly, and it leaves you out of it, and you can avoid potential tax IRS problems by doing that. But yes, you can.
Wait, I know this is just going to be your opinion, but if you had the money to pay off your house or invest in this, is the smarter thing to do to pay off your house?
So, Lori, here's the answer to every one of those questions. It depends. So
That's the answer to our questions in our office. Everything is, it depends.
that's the right answer.
That's it?
So some of the variables you need to look at are, what interest rate are you paying on your mortgage? And what investment returns is your retirement account or other accounts getting for you? If you can earn 5% and pay the bank 3% on your mortgage, or 4%, you're still making that 1 or 2% above it. Or some people say, I don't care. I want out of debt. I'm going to get rid of this mortgage. So I'm not going to give you a very specific direct answer. It depends. But those are some of the variables. Some people don't care that they can invest it and make more money with that money because they just want to get out of debt. And if that's the case, then great. Taxes and I mean, there's enough variables, and some of them aren't monetary variables. They're just, I want to get rid of debt because I hate debt, and that's what they do. So good luck with that. With these accounts, you may or may not have heard something called an RMD. It's a required minimum distribution. Some people think I'll put money into here and I think I may not need it when I retire, and I'll just leave it for my kids and I'll just let it grow forever. That's a great idea. Your kids will be taxed on it if there's some left and when they get it. But when you hit 70 and a half years old, random age, I don't know where the IRS came up with that, but when you hit 70 and a half years old, they will require you to take some distributions. They're going to require you to start taking some out because they want some of their tax dollars. So that's what an RMD is, required minimum distribution. There's a formula, a chart, they have this life expectancy, and you do this calculation. These companies will do that calculation for you, and you have to start taking it out. So just is what it is. Again, these 100% of any distributions, money you pull out of these accounts will be taxable. So you save tax today, hopefully they grow, and then you pay tax later. The theory behind that is today, theoretically, you're making more money today than you will be down the road, because remember, $5,000 equals $4,000. So you may be able to pay a little bit less tax because you might be able to pull your income down into lower tax brackets. Questions?
That required minimum distribution, is it based on formula, like what is the least amount you are required to take out each month?
Yeah, so it's a formula that the IRS has come up with. Basically, it's based on the value in the account at the end of the prior year. And then they take your age, and based on your age and your life expectancy, they have charts for this. They take a factor based on your life expectancy and multiply it by the value in your account in the prior year.
There's a calculator there for that, an estimated calculator I've got in there, and it was something like $1,000 a month.
Yeah, it's fairly minimal usually, but it all depends on the value in the account. Yeah. So I've seen it be $30,000 a year. I've seen it be $500. It just depends on how big that account is. Hopefully the account's really big, and you have to take a lot out. Great question. Any others? Pam?
When I started a 403B years ago, the minimum amount you had to put in a month was $25. What's that amount now? If someone wanted to start one.
I don't know if minimums, but we probably wouldn't handle anything lower. 25 is a good number. I mean, to do 2 or 3 or 5,
Right.
It's a lot of paperwork.
I just wondered what that minimum was. So
Yeah.
if anyone wanted to start one.
We have some 25s, and so 25 is a good number. 25 or up. Thank you. All right, so I wanted to show a couple of examples to kind of illustrate what happens. So on the left side, again, assuming $5,000 a month, take Social Security, Medicare, ASRS out, you're left with $4,012 paycheck. In the tax world, taxable income basically never matches cash flow, just FYI. So your taxable income is $4,394, and just with a big assumption of a tax rate of 25%, your tax would be $1,098. If you decided, you know what, I'm going to put $500 a month into a 403B or 457 or half to each, as you can see here, you pay yourself $500 by putting that into your retirement account. It's going to lower your tax bill by $125. So I just kind of wanted to illustrate what that may look like when you decide to do that. Again, the disclaimer is I'm not telling you you're going to save $125. I'm telling you you can save money. Your situation is going to dictate how much that money is going to be. How much is the contribution, what your tax rate is. Your spouse may make a lot of money and put you up in higher tax brackets than the other person you work with that's married and has 14 kids and doesn't make a whole lot. Every situation is so different. So, so that's one example. The other example that I talk to people a lot about is, let's say tomorrow is your retirement date. Tammy's going to retire tomorrow, and she has $25,000 of sick and vacation that she's going to get paid out. These accounts right here are, I love using them for this situation, because a lot of times the person doesn't necessarily need that $25 right now, but if they don't do anything, they're going to get slammed with a big tax bill or a lot of tax withheld out of that check. And sometimes it'll bump you into higher tax brackets. So as you can see on the left side, the normal $5,000 a month for your last paycheck, but then the $25,000 sick and or vacation payout, the normal Social Security, Medicare, ASRS. I'm not deciding to do a 403B. I'm going to get $24,000 in my paycheck. That's awesome. Great. $6,500 of it is going to go to Uncle Sam. Or I can decide, you know, this one time on this one paycheck, I want you to put $20,000 into my 403B. You set up a 403B. We withhold $20,000 out of that paycheck, and you still get $4,000. Your taxable income is only $6,300, and you save $5,000 in taxes just by doing this. And it's still your money. And depending on your age, a month from now, you can take out a portion of that $25,000. So you control when it becomes taxable and when you need it, and not just give it all a quarter of it or whatever your case may be to Uncle Sam right now. So when you get to that day when you're ready to retire, if you have a vacation balance or if you have a sick, if you qualify to get your sick pay paid out, think of this, because this is an incredible tool to save taxes, put money away for yourself, and keep it. That's all I have. Any questions? Timely. Oh, thank you. Come see me if you want to open up an account, or later if you open the account and want to change the amount. Either way, come see me, and we have the forms in my office to help you fill that out and decide how much. We don't give tax advice, at least I try not to. After 15 years of doing that, it's hard not to give my opinion sometimes, but I'm trying to keep my mouth shut sometimes. But come see me, and we can help you get that set up.
So, Wayne, should we shop around and look at the rates for the options that we have, or do you guys have a sheet that provides all of the,
I have, as far as the piece, I have not seen a rate sheet. You're probably, I'll see if we have one. I took this responsibility over like 2 months ago. So as far as these forms go, I'll see if we have a rate sheet. And maybe we can email that out to you if we do. Otherwise, it's kind of a delicate balance, because the college is not in the business of advice, but if we can give information to help you seek advice and make decisions, I would love to do that. What else?
Is it too late to start it for this year?
No. Nope. No, we can set it up tomorrow and get going, or it's whenever. Yep. There's not like an enrollment period like health insurance. There's no enrollment period. You just come in and see me and we can get it started. Pace and Globe. All right. Thank you.